Hello, ladies and gentlemen. My name is Greg Michalowski, and let's take a technical look around the Forex market. Today's date is July 2nd, 2014. Let's start with the euro versus the US dollar. That blue line in the chart right here represents the 100-hour moving average. The current price in the last hour just came up to that level at the 136.53.7 level, and the market has come off a little bit, currently trading around the 46 level. Our range here in trading today is only around, I think it's 40 pips, around 40 pips for the euro versus US dollar. Yesterday we had a 25 pip trading range at the highs. The market tried to move higher, couldn't, fell below trend line support and started to rotate to the downside. So there is some selling momentum in this currency pair, although it's limited, but stay below that 100-hour moving average now into the afternoon. And we could see a rotation further down, an extension maybe of the low that could take the price down toward the 136.30 level. This is the 200-hour moving average in the euro versus US dollar. If the market moves above our 100-hour moving average, that could solicit some buying interest or some short covering by intraday traders. We moved above that level on the weaker than expected factory orders today, but that move to the upside was quickly reversed, and as you can see, we've moved back a little bit lower in the last hour or so of trading. So that's a euro versus US dollar. Let's take a look at the pound sterling against the dollar. This currency pair had better economic data again today. Construction PMI at high levels, and that helped propel the pound sterling, or keep the bid in the pound. This is a day when the dollar is relatively stronger on the back of a better than expected ADP report that came out earlier today. So the pound sold off on that ADP report, but as you can see, we've rebounded back to the upside and stay near our high price. Taking a look at the daily price, the move yesterday took our price of this currency pair above topside trend line at the 171.16 level. That level here today is around, I guess around 20, no, it's around the 20 level is where that trend line comes. That trend line connected 1, 2, 3 different points, broke above it yesterday, staying above that level in trading here today. That is bullish on the weekly chart. We are trading at the highest level going back to, I think it's October of 2008. At breaking above or moving above the high price from 2009, and if we stay above that level at the 170.41 level over the intermediate term, currently trading at 171.63, so a good 120 or so pips above that level currently at the moment, but staying above that level keeps the door open for a move toward the 50% retracement midpoint of the move down from the 2007 high to the 2009 low. That level comes in at 173.31. So bullish bias remains in the pound versus US dollar. Let's take a look at the dollar versus yen. This currency pair fell below the 200-day moving average and closed below 200-day moving average for the first time going back to, I think, this day right here in October of 2013. And prior to that, the last time the market closed below the 200-day moving average was all the way back in November of 2012. So this break of the 200-day moving average is not to be taken lightly, and the market did, in fact, move lower. But today, what did we do? We came back and we moved back above that 200-day moving average. We also moved above the top side, or this trend line connecting a low to a low to a low here. In yesterday's trade, we moved right up to that underside of that trend line right here. Today, we moved above it, moved above the 200-day moving average. So things are looking a little bit more bullish here for the dollar versus yen, helped again by that ADP report. This is what it looks like on the hourly chart, folks. Take the most recent high, the low. This is the trend move to the downside. Started to recover, had a little problem around the 100-bar moving average. In today's trading, we moved lower first, but then had that ADP report, and that forced the market to the upside. Initially found some sellers against the 200-hour moving average and the 50% retracement, but have since moved above that level. Guess which is where support now comes in. 200-hour moving average comes in at 101.68.8. 50% retracement comes in at 101.69. And you see this thick this thick green line right here, that is the 200-day moving average. So if I were to be a risk-defining trader, which I am, this would be where you'd want to see the price stay above in order to keep the bullish bias going here for the dollar versus yen. By the way, these two lines right here, this red line and this red line right here, represents what is the average trading range over the last 22 trading days. So the dollar yen has reached that 22-day average. You know, sometimes the market just has this internal clock that we've gone enough, so we're seeing a little bit of resistance against that level. Support down here, folks. Got to stay above the 67 to 69 level if you're bullish on this currency pair. Dollars versus Swiss is an interesting pair as well from a technical perspective. Look back here a few days ago or last week. The market held the 100-hour moving average and moved lower. And today, where did we correct up to? The 100-hour moving average off that ADP report. The market found sellers against that level. Couldn't sustain the rally up there, had weaker factory orders. Now trying to recover again, trying to get a move or see if we can get a move back above that 100-hour moving average. If we can't get above this level, then the market's going to rotate back to the downside. This is, by the way, the 100-day moving average. So this is a 100-hour moving average. This is a 100-day moving average. Today we found support buyers against the 100-day moving average, found support resistance sellers against the 100-hour moving average. It's proving to be an interesting setup, especially in front of the unemployment report tomorrow in the U.S. and ECB interest rate decision. The question is going to come, do we go that way or that way for the dollar versus Swiss? The lines in the sand are drawn. Let's take a look at the Aussie versus U.S. dollar. Another interesting pair. Take a look at the daily chart. Look back at the May high. The May high for this currency pair came in at the 94.60 level. We moved above that level in trading yesterday, and it looked like the market was going to surge to the upside. Not so fast, folks. Trade data came out weaker than expected in Australia, and the market moved lower. We corrected here, creating a nice little head and shoulders. Isn't that like a shoulder, a head? Head and shoulders, knees and toes, shoulder, head, shoulder. Market broke through that shoulder here off the ADP report. The market moved down to the 50% retracement of the last leg to the upside and the 100-hour moving average. Now consolidating above that level, below the head and shoulders level on the top side. Again, support and resistance are being defined here from a technical perspective. Maybe waiting for that employment report and ECB interest rate decision tomorrow to make up our mind. Finally, let's take a look at the New Zealand versus U.S. dollar. This too is near high levels, similar to what we saw in the Aussie versus U.S. dollar last week, or actually, last week on Friday. The market moved above the high price, most recent high price, going back to May. Prior to that, you have to go all the way back to here in July of 2011. Yes, July of 2011. Well, yeah, I guess so. I guess that's right. So we moved above that that high price, and did we see momentum? No, we saw. This is that high price in May. We saw a move to the upside fail, move to the upside. That's 2. This is 3. This is 4. Bigger correction here. This is 5. Semi-correction and trading here today. Double bottom and trading here today. But look at the high today. The high price today stayed below that May high. Okay, this is the May 2014 high. Stayed below that level. So we're trying to create a top here in the New Zealand versus U.S. dollar. But we have a double bottom. We haven't gotten below the 200-hour moving average. We're trying to stay below the 100-hour moving average now at the 87.62 level. This is the borderline top. If you're short this currency pair, you don't want to see the price move above this level. If you're short this currency pair, you want to see the price move. You want to see the sellers try to take a little bit more control than this little move to the downside. We need to get below the 200. We need to get below the 50% retracement. And if we do that, then they have a little bit more control, and traders might be saying, the top's in place here, or we got a little bit ahead of our skis here. We're not quite ready to take the New Zealand versus U.S. dollar all the way to the upside. After all, the Reserve Bank of New Zealand and Wheeler doesn't really want to see this currency pair continue to move higher. They don't think they think it's overvalued here, even though they're likely to continue to tighten rates. There is bullish interest rate reasons to buy the New Zealand versus U.S. dollar From a technical reason, however, which is what we deal on here, a top may be in place. Markets do get overbought at times as well. So there you have it. They look at some of the major currency pairs. If you are interested in this video and want to see more, then click on the subscribe button here. And also, for more information on trading Forex, visit me daily on my new website at GregMikeFX.com. Bigger and better things to come down the road. This is just a start. I'm looking up to the sky.